This is my co-host Ryan Janelle. Ryan, how are things today?
Today, I'd like to be referred to as Tim the Toolman Taylor. So, Heidi Ho neighbors, because we're putting another financial tool in people's tool belts today.
You're right. The topic today is cash damming, tax hack, or wealth engine. And the reason why we want to talk about this topic today, Ryan, is because over the last, I'd say, 6 to 12 months, I've had a lot of individuals ask me about the strategy and if it's something that's suitable for them. There's a lot of misunderstanding about the strategy itself and how it all works. So today we're going to discuss, well, what the strategy is,
Mm.
some of the mechanics behind it all, who it might be appropriate for, and would it potentially be appropriate for you as someone who's considering the strategy itself. Um, Now, Ryan, before we get into this, like, have you heard about the strategy prior to me bringing it up over the last couple of weeks?
I had not actually not heard about it. So,
Yeah, and I don't think it's anything that is necessarily mainstream. I don't think this is something that like everyone we're talking about is doing or heard about it. I would definitely say, in terms of the strategy, before we get into it, I think it's something that is you're better suited talking to an accountant about the mechanics behind it and how it all works and what's allowable and not allowable. So we're not here today providing any type of tax advice at this point. All we're doing today is making you aware of the strategy, our understanding of how it works, and then you can decide for yourself if you think it's something you might want to explore. Because again, this is something that is not, I would say, common. And if you're someone out there who's implemented the strategy for yourself, or if you're someone who has helped people implement this strategy, we invite you to message us, comment. So right now we're live so on the different social media live platforms. If you want to comment, that'd be very helpful because Ryan and I are definitely learning a lot more about this. If you're not watching this live, again, we invite you to comment in the comment section or to reach out to us directly at financial@tvhgroup.ca. So, Ryan, let's get the ball rolling. We did look at a couple of articles on this. There's a calculator that we found, but I'm going to start off with kind of like the intro because I think it'll give people a sense of what we're going to be talking about. So, what if we told you there's a legal way to turn your rental income? So this is again a strategy that's designed for people who have a principal residence and rental properties. Okay. So we turn your rental income into a tax deductible machine. And you might ask, well, isn't the income already tax deductible because it's a rental property? Well, that's where we're going to kind of get into the mechanics behind this. And it's while accelerating your path to financial freedom. So today, we're diving into the cash damming strategy. It is just a clever tax play, or is it just a clever tax play, or could it be your next wealth building superpower? And I think that's the other thing we're going to talk about today, Ryan, is it strictly a tax strategy or is it a wealth building tool, right?
yeah, yeah.
So, do you want to kind of give it a go in terms of what is cash damming from what you know of it?
Yeah, and like I said, preempted to adding this, it made me again realize what a great team that we have at the TVH Group, because we have, our special tax person, Dave. We have a mortgage person and specialists that you'd likely have to bring into this strategy also to make sure that it's happening. So ultimately, the definition, cash damming is a strategy that turns non-deductible debt, like your home mortgage or personal line of credit, into a tax-deductible debt. So we obviously, you can't do anything about your personal residence, but you can do a lot of things with the assets that you buy. In particular, we're talking about, for today, we're going to talk about if you have a rental property, right? So here's how you use it in simple words. Use your rental income to pay down your personal mortgage or other non-deductible debt. Then you borrow money to pay your rental property expenses like repairs, utilities, insurance, or taxes. Because the borrowed money is used to earn income, the interest on that borrowed money becomes tax deductible.
Right. So
So
where this strategy would be beneficial is that, first of all, if your principal residence, if you had what's called a readvanceable mortgage. So just to simply explain, and we're not mortgage brokers or mortgage agents here, so this is our understanding of a readvanceable mortgage. It's a mortgage where when you make a principal payment, so it could be lump sum or monthly, and then within a couple of days, some of them there's a delay of about a week or so, that principal pay down now gets readvanced into a line of credit. So, for example, if you paid down $50,000 on your principal on your mortgage, then you receive what's called a $50,000 readvanceable line of credit. Okay, so think of it as kind of like an umbrella strategy, right? As you're paying down your principal, your line of credit limit increases. So with that readvanceable line of credit, then what you do, according to the strategy, is you borrow from the line of credit to pay the rental expenses, but not all rental expenses. Okay. And we'll get into what's potentially allowed, or the most important one, what's not allowed. Okay. So you use that money to pay those expenses. And then what happens is the interest expense on the line of credit, because you borrowed that money to pay off expenses from a rental property, the interest now becomes tax deductible. So you've actually created another tax deductible expense for yourself. So if you're someone who's, for example, at the highest tax bracket, you're a salaried individual, um, and you're receiving income at the highest tax bracket, well, whatever that interest cost is, you're saving money because now it becomes tax deductible against the income, against your salary. And then you would potentially receive some form of refund. Again, that's not guaranteed. This is why we encourage people to go actually speak with an accountant to determine if this would be appropriate for them. Okay. So that's the mechanics behind it. But there's a lot of moving parts, right? And the one expense, and this is where a lot of people misunderstand the strategy, and I've had this many times. The one expense that you cannot use for the strategy is the actual mortgage payment on your rental property. And the reason for that is because with the mortgage payment, the accountant is already claiming the interest expense on the mortgage of the rental property. So if you borrow from your personal line of credit to pay that to cover the mortgage payment, it's almost like you're double dipping, and that's not allowed. So I'll use some basic numbers. If you're someone who has a rental property generating $3,000 a month of rental income, what the strategy is saying is, well, let's say out of that $3,000 rental income, $2,200 of that is your mortgage payment for that rental property. You can only use a strategy on the $800 remaining, which potentially covers your condo fees or taxes or whatever other rental expenses. There have to be rental expenses to offset it.
Mhm.
So that's the amount you're allowed to incorporate in the strategy. Is that clear as mud?
That's clear as mud so far. Yes.
So the reality of it is it's a complicated strategy. It really is. This is why you want to speak with an accountant. One of the recommendations that's made with any of these types of strategies that we talk about is you should run everything through a separate bank account. So you shouldn't commingle
Yeah.
So if you have your regular checking account, you shouldn't be running your personal mortgage from there and your line of credit, the rental expenses. You should try to separate the two, because if CRA ever comes calling and they want verification, there's an audit, they want a clear path, and making sure that they can identify that everything that you're claiming is in fact for that rental property, right?
Yeah, everything I was reading about it is very clear about keeping everything separate. If you're not very good at keeping records of these things, this isn't the best strategy for you to do, because you can get caught up in some of the knock on the door from CRA. So it's very important, whether yourself or that, again, working with a great accountant is able to help you in the bookkeeping of keeping all this stuff separate and making sure that you have separate accounts, as you said. And it made it a lot clearer. And I know one of the things, and was kind of trying to figure out for myself was, obviously it's, if you're a homeowner, the other thing principal residence was asking or saying that it was best recommended for people who had at least about 15 years still left on their mortgage on their principal residence, which I found very interesting as far as the educational piece. So
Yeah, and it is a slow buildup too, right? Because for example, let's say you were able to claim $10,000 in the first year of interest expenses, right? On that 10,000 at, let's call it 5%, that is $500 in an interest expense that you can claim.
Mhm.
So in year one, you've now created a $500 tax deductible expense. If you're at the highest marginal tax bracket, let's just use 50% as the average, then you'd receive a refund of about $250.
Mhm.
So in year one, the accounting fee might actually cost more than your benefit. But then what will happen is in year two, assuming all the same numbers, well, now you have $1,000 in a tax deductible expense. So at your 50% tax bracket, now you're receiving $500 back. And so there is a bit of a compounding effect to the strategy itself.
Yeah.
So just keep that in mind. It's not an immediate win for a lot of
Yeah.
people. It does take some time, right? And then the variables too are obviously if the interest rates go up or down on the line of credit.
Yeah.
That's also another factor as well.
I figure also 15 years, there's a lot more expenses that come up over a 15-year period that would be versus a shorter period one, right? Suddenly you need a very big expense that needs to be part of that package. So
Yeah,
yeah.
yeah. So what's the positive? I mean, one of the positives that we just talked about is that tax deductibility,
Hmm.
right? So for the same numbers, you're now creating yourself an additional tax deductible expense. And if you're a salaried individual who's prepaying your taxes, right? So it's coming off your paycheck, you should be able to recapture some of that in the end of the year, right?
Yeah.
So that's I think a pretty strong case there. But I know when we talk about some of the other ones that kind of came up that what we've read, they say, well, it's simplicity, right? It's not a simple strategy from what we have found.
Yeah.
It is very complex, right? So I'd probably put that in the negative category,
Yeah.
right?
Yeah.
So there's that, and then the cash flow optimization for landlords.
Yeah.
I disagree with that point because
Mhm.
here's the thing. Again, if in year one you've created a $500 tax deductible interest expense, you have to service that debt. So that's actually eating away at your cash flow. And then in year two, if now you owe $20,000 and there's $1,000 interest expenses, right?
Mhm.
You have to service that debt. You can't capitalize it.
Yeah.
So when I kind of read some of the articles out there, and when they talk about the benefits and whatever else, and they say that it's cash flow optimization, it's like no, you're actually deteriorating the cash flow over time
Mhm.
because your principal mortgage payment is still going to be there. Now that principal mortgage payment may lower every time your 5-year term comes up, for example, and now you're at a lower balance. Um, but again, you have to run the numbers to make sure that's the actual impact that happens because it doesn't always happen, right?
Yeah. Yeah.
So, anything else you want to add to that before we talk about some of the additional drawbacks?
Um, I think everything. I'm going to say this. It is July 2025, and everything that I read at the time of this recording
Yeah,
was, the CRA always wants to come collect their dollars, right?
yeah,
So they're always looking for ways to create a new tax code or a line within tax code line number 47.5 I dash 2 dash whatever to make sure that they're collecting. So I will say this at the time of our recording in July 21st, 2025,
yeah.
this currently is a strategy that people can use. So the Marty McFly or the Bill and Ted Excellent Adventure people of the future that are potentially listening to this, it may or may not be a strategy that is in place. But I'm sure
Yeah.
people who love to have the tax act sitting by their bedside table is evening reading, we'll find a new strategy in the future to ensure the CRA is looking for ways to collect more of our dollars. So,
Yeah, and I think why people like the strategy too is to the point of they want CRA to have less than they need to have, right? And they want to pocket as much as they possibly can. So why not do this? It's a couple of additional moves that you have to take to benefit from it, right? So I can understand why people, once they hear tax savings, screw the government and I'm going to keep more in my pocket. I can understand why they would be attracted to this,
mhm,
and but there are some drawbacks that they have
yeah,
to consider as well, right?
yeah,
So some of the drawbacks, well, we talked about it already. Strict recording.
yeah,
You can't, you're just not. If you're a salaried individual and you're busy with a young family, chances are you're not going to want to spend the weekends record keeping on the transaction, especially if you incorporate this with multiple rental properties,
mhm,
right? So you're going to have to hire someone, and there's going to be a cost in doing that. But there is strict record keeping for this type of strategy, right?
yeah, yeah.
Yeah.
And it is, as we said before, the drawbacks are it's not suitable for everybody. Obviously, you're
Yeah.
looking for a particular client that has their own principal residence, that has a rental property. It also stated that it can be beneficial for self-employed people too, but for most salaried employees that don't have any rental income coming in, then
Mm.
uh, go to our other episode talking about the mortgage maneuver. I can't remember what we
The
called
tax
it.
deductible mortgage strategy.
Thank you. So that's a different episode. So
Well, that's a good segue because here's the next question: is can this current strategy that we're talking about, the cash jamming strategy, is it a wealth building tool or a strategy? And I know, again, in some of the documentation that I've read, that's how it promotes it.
mhm,
I don't believe that it's really a very good wealth building tool.
yeah,
And the reason for it, if we're going to compare the two strategies that we talked about with this one here, and I'm just going to, again, use very simple numbers to try to explain the strategy. But on the cash jamming program, let's say you have $1 million home as your principal residence and you have a $500,000 mortgage on the home. And on the right side, you have your rental property that's also worth $1 million with a $500,000 mortgage on that property. Okay. So you have $2 million in assets to start off with, $1 million in debt on both. So your net worth is $1 million. And we're not going to incorporate tax and all that stuff right now. This is all gross numbers. Okay. You incorporate the tax damming strategy. You project out 25 years. Your $1 million home is worth $2 million, and you've paid off the mortgage after 25 years on your principal residence. Your rental property is also worth $2 million 25 years down the road, and your $500,000 mortgage on that property is also paid off. So now you have $4 million in assets 25 years later, but you still have a $500,000 line of credit.
mhm,
So your net worth is 3.5 million. Not bad, right? But that's your net worth 25 years later. However, if we try to do the same thing, but instead of the cash damming strategy, we try to incorporate the tax deductible mortgage strategy where we're converting that non tax deductible debt into tax deductible debt. The difference is the money that you borrow is actually used to now invest. Now, it doesn't have to be a portfolio investment. It could be a rental property, it could be in business, whatever else. As long as it's generating some form of income,
mhm,
you can claim the expense. So now, if we use the same time horizon, your $1 million home is now worth $2 million 25 years later with zero mortgage on it. Your $1 million rental property is worth $2 million with zero mortgage on it 25 years down the road. You still have that $500,000 line of credit, but with that $500,000 line of credit, you've invested it in, let's call it a portfolio that's now worth $1 million 25 years later. So now you have $5 million in assets. Subtract the $500,000 line of credit. Your net worth is $4.5 million, right? So I would argue that the tax deductible mortgage strategy, which does the exact same thing as the cash damming strategy does, builds wealth where the cash damming strategy doesn't.
Mhm.
Now, the other, I would say, risk with cash damming is if you happen to lose your job, if cash flow becomes a problem all of a sudden, you basically have this line of credit that you have to service and nothing to help you pay it down or kind of service the interest costs. With
Mhm.
the tax deductible mortgage strategy, yes, there's a risk. It's leverage. You're leveraging. So we have to say that that is a level of risk that you're taking, no different than cash damming.
Mhm.
But the difference is you're investing in some kind of portfolio liquid investment. So if there is a cash flow issue at some point in down the road, at least you have some liquidity, some assets you can tap into to help get you kind of through that hump for that period of time,
Yeah.
right? So I would definitely would want someone to who's considering cash damming is to let's look at both and let's try to figure out which one actually offers or helps create wealth.
Yeah.
Now, where some people argue that the cash damming tool will create wealth is once you get that tax refund, you can then take that tax refund, pay it down on your principal mortgage, re-advance it, and then from there invest it into something.
Yeah.
But here's the thing: if in year one you've created a $500 tax deduction and you receive a $250 refund that you apply on your mortgage to then borrow that 250 into a portfolio, and the following year that 250 you can now add another $1,000 or $500, so you're at 750. Like it's a slow build,
Yeah.
which is very different from what we're suggesting with the tax deductible mortgage strategy.
I think part of it is the mindset around it, and everything comes down to people's mindset. The mindset of feeling good about sticking it to the man and not paying enough as many taxes.
Yeah,
That may be a feel good moment for some people,
yeah,
right? So,
yeah,
but as you said, everything comes down to let's look at the numbers. Let's run what each of them is going to look like over the course of 10 years, 15, 20
yeah,
years, and what makes better sense based on an individual's goals
yeah,
versus what Tim the Toolman Taylor's neighbor is saying he's doing, right? So, because
yeah,
Tim's neighbor, whose name I cannot think of, has a different strategy than Tim and his
yeah,
family. So,
yeah, yeah. It wasn't Al that was his sidekick.
no,
Wilson. It was
Wilson.
Wilson.
Okay.
Yeah, it was Wilson. The other thing that um, what we're reading where it could potentially help build wealth is because it can potentially pay down your principal residence quicker,
Hmm.
right? And when I run the numbers, like I'm seeing that usually it might be like a 1 to 2 year um, accelerated pay down, right?
Yeah.
So it might knock a couple of years off your amortization, which is good, right? But again, you're still carrying this debt down the road at some point that has to be addressed at some point,
Yeah.
right? So that's our bit on the cash damming strategy. And we're not here saying that you shouldn't do it or you should do it. It's here's our opinion of it. And again, seek out professional help if this is something you definitely want to dig into, right? So now the question is who should consider it?
Well, as I said before, a lot of real estate investors tend to talk about this from talking with you and in the last really few weeks that we've started talking about this, and self-employed professionals. Those are the two biggest considerations for the ideal profile for somebody wanting to do this. And obviously, as we've just discussed, when does it make sense for somebody to do this? Is a big important conversation that you're going to have. I will always go back to document, and making sure that you're doing the right things, talking to the right professionals, consulting with, as you have already said, and we'll say it again, a tax professional, then bringing in a specialist like John on the next step, and then for us to make sure that we're helping you achieve your goals. Again, part of the reason why we did this too was just education about putting something else out there as something people can think about as a different tool. Again, 2 weeks ago, I had no idea what this what this was. This was an option. And as I've said many times before, that is the great thing about having a team, is that we're able to bounce ideas. And when things come up, we can either prove or disprove a lot of the stuff that often social media kind of promotes as this is the all answering, all powerful way of doing it as a tax strategy. Um, and yeah, I think that's all I have to say about that.
Well, I think what I like about kind of approaching this type of program with the team is we don't necessarily all have the same opinion of a
Yeah.
strategy. So I think what I like about it is that, from the advisory team within TVH Financial. So when I say advisory team, that would be you, Eric, and Denis, and myself, to kind of like the bigger group within TVH Group. We can sit at a round table, and we're going to have one soon at our new boardroom. So stay tuned for that announcement. But we can sit around the boardroom table and hash it out. And what I might think sounds like fantastic and something that we should be incorporating, someone else might come back and provide their angle on it, or maybe there's something that I missed or didn't see or wasn't aware of, right?
Yeah.
So that's the benefit of working with a team like us, because you know more heads are better than one. So um, more brains, I guess, is better than one, right? And
Yeah.
we have a lot sitting around that round table now with
Yeah.
different expertise, different experiences, different licensing, different education. So I think people will definitely benefit from working with us as a group for sure.
Yeah.
Right. So just to kind of wrap it up, in terms of professionals that could help you with this strategy, um, there's really two main ones: the mortgage broker or agent, and like Ryan mentioned, we have John at TVH Mortgages. You need to make sure that you have the right type of mortgage set up in order for the strategy to work for you. 'Cause a traditional 5-year term mortgage that's not readvanceable is not going to do it. Secondly, and probably most important, is the accountant, because they're the ones that are going to have to record keep all this. So find out what is it going to cost you to run the strategy as well,
Mhm.
right? So they're the next professional to really be working with. Obviously, if you're doing some form of refinancing, changing your mortgage structure to implement the strategy, you need a strong mortgage or a real estate lawyer. So we have Sonia Kosover at TVH Legal who can assist you with that. And then if you're just looking for a third party opinion, right, on the strategy, or if there's a better way of kind of reaching that goal that you're setting out for yourself, there's obviously us at TVH Financial and our advisory team that we can help you as well. So,
Mhm.
Ryan, is there any call to actions that people should be aware of?
Call to action. Call TVH Group and find out how, with any strategy, making sure that it's fitting you, your risk level, and your goals ultimately.
Yeah. Yeah, and I love the risk level part of it, because this is both, again, cash damming or tax deductible mortgage. It's a leverage strategy. It adds risk to your overall financial profile, so you need to be aware of the risks involved as well. So, for anyone who's watching, listening, I know we're in the deep part of the summertime right now, so maybe someone's sitting there on the beach listening to our podcast. If so, and you like what you heard or you like what you've seen, we encourage you to like, subscribe, share. Um, we're increasing our listenership, so the content is getting out there. People are liking what they're hearing. We're not for everybody, but we are for the right people. So please help us out in sharing our channels. We'd appreciate it. If you have any other questions, you can find us at tvhfinancial.ca, 647-727-4668, or you can email us financial@tvhgroup.ca. And then finally, you can find us in all our social media accounts, including TikTok. So, Ryan, I think that's a wrap up for today. We can go out and enjoy some of the sun and the beautiful weather like
Yep.
everyone else. And until next time, have a wonderful evening. Take care, everyone.
Take care.